So we got yesterday the Fed's decision. They're going to cut rates 25 bips as expected. It's another one, um, second one of this kind of I'd call phase two of easing in the long-term cutting cycle, right? Beginning in September 2024, took a pause. Now we're back on again. The one we didn't get or didn't know that we were going to get for sure ahead of this was the end of QT. So QT is the balance sheet runoff, basically the Fed's holdings of treasuries, mortgage-backed securities, agency debt. Those as they mature, instead of just kind of vanishing into monetary ether, they're going to start recycling those proceeds of principal maturity and interest payments into treasury bills. So this was the net new, but the market didn't know that they were going to get. And the other piece of guidance that trading desks, who are involved in, just moving markets in U.S. Treasury debt and foreign exchange. The other piece of the puzzle that they got yesterday that they didn't have before, which is really the information, right? That's what prices are reacting to, was Powell's kind of hedging of his statements to say, hey, don't just assume another rate cut at the next meeting in December is a foregone conclusion. He mentioned that there may not be board consensus at this point for that next cut to happen. Could still materialize. We'll see. There's a lot that will shake it out between where we stand today at the end of October and when that next meeting is, middle of December. But we're on kind of a 6 to 8 week, just kind of steady as she goes type of course. We're going to follow the existing trends. The other piece that was kind of an unknown to market trading desks was how that QT would cease. Right? It's got part of the announcements was this will QT will officially come to an end on December 1. And what's going to happen is, we knew that what it means with QT is the runoff will eventually be redeployed into other credit assets. What we got on yesterday's announcement, this is kind of a sister publication from the Federal Reserve Bank of New York, which is actually like where the FOMC conducts its policy, right? It integrates with the financial markets, with the capital markets in New York. The seat of the global dollar hub, right, or the main seat. Federal Reserve Bank of New York is going to take those principal maturities and interest payments as they come in, and the treasury debt they're going to roll over into, they mentioned it's going to be treasury bills, and they're going to skew. It's going to be about 75% hitting into 1 to 3 month maturities, and then the other 25% is going to be the 4 to 12 month. So what this is primarily going to do, this is just kind of old school Alan Greenspan monetary policy. Fed is going to come in as a non-competitive bid, which is going to pressure front ends down, right? More of that volume or more of that, repurchase volume coming in is going to hit the front end the first 3 months. That's going to force pressure on discount rates to come in the bills market. So from the normalization of the yield curve, that front end is the last bit that's remaining inverted at this point. What this policy is going to do is essentially squeeze that last bit out. The thing about Jerome Powell's statements that was kind of the surprise for markets to absorb was it's not going to come all at once. You're going to have to put this in a crude analogy. It's like pushing your kid into the deep end of the swimming pool and not coming in to rescue them right away. You're going to have to learn to swim, right? And granted, if there is an emergency, if it turns out the kid can't swim, FOMC is not going to let the child drown. They're going to hop in. They're going to save it as they did in other circumstances, say 2019, repo crisis, et cetera. They're not going to let it faceplant. But what they're saying is, we're like, show me something here. You're going to actually have to fight through this one and learn to swim.